Ever feel like just keeping up with, I don't know, your money, your health, your future plan? Like needing a full research team.
Oh, absolutely. It's a lot to track.
What if you could get a bit of a shortcut?
That sounds pretty good right about now.
Well, welcome to the deep dive. We're digging into a stack of sources curated just for you. They're pulled from the news, aggregated on Consumers.App as of May 28, 2025.
Right. And it's quite the mix today. We're sort of getting the snapshot, aren't we? Consumer trends, finance, policy stuff.
Exactly. Think of it as a pulse check on things affecting, well, all of us.
It really highlights how these headlines, even if they seem disconnected, actually tie back to our own lives or planning.
Yeah, totally. We've got everything from expert takes on money to, big global policy shifts.
So where do we start?
Let's kick off with something really fundamental, I think. Trust, especially trust in information. We've got a headline here from The Hill. Kennedy takes on conflicts of interest in medical journals.
Ah, conflicts of interest, COIs.
Right. Now, these aren't just like academic jargon, are they? What exactly are we talking about here in the medical world?
No, not at all. Basically, it's when researchers or maybe the institutions they work for have other interests. Could be financial, could be personal, maybe political ties.
Okay.
And these other interests could potentially skew their judgment or their work. They might compromise impartiality.
And why should the average person, reading health news care about this?
Well, because it matters a lot. If research is biased, even if it's not intentional bias, it can lead to, bad information getting out there.
Misinformation.
Exactly.
Yeah.
And that doesn't just chip away at trust in science, which is bad enough. It can actually influence real-world health decisions people make, public policy, even what drugs get developed or approved. It's serious stuff.
And this connects to peer review, the system that's supposed to catch problems.
It does. Peer review is meant to be this quality check, right? But if these conflicts aren't disclosed, if the reviewers don't know about potential biases, then research that might be flawed or tilted could slip through. I see. Yeah, the source mentioned some examples where undisclosed conflicts were linked to certain advocacy positions. It just shows how distorted findings could, get into the public conversation and potentially cause harm.
So what's the fix? Or what are people suggesting?
Well, things like much stricter rules about disclosing all potential conflicts, and also ideas like open peer review, where the reviews and identities are public. The goal is transparency, really, making it easier for everyone to assess potential bias.
Makes sense. Okay, so from the integrity of health info, let's pivot to the economy's pulse. The New York Times has this. Fed well-positioned to wait on rate cuts, even as economic risks rise, minutes show.
Ah, the Fed. Always keeping us guessing.
So what's the story here? Are they cutting rates or not?
Well, the main takeaway seems to be patience. They're signaling a wait-and-see approach, even though there are some, economic uncertainties bubbling up. The minutes from their meetings suggest they feel they have the breathing room to hold off on cutting interest rates for now.
Just wait and assess.
Pretty much. See how things unfold before making a move.
And we know the Fed doesn't operate in a vacuum. Their words, their signals.
Yeah.
They move markets, right?
Oh, hugely. What the Fed says, or even just the sentiment people perceive from, say, the Fed chair, that can definitely influence financial markets.
Like stock prices.
For sure. Things like the S&P 500, even the price of ETFs, those exchange-traded funds, lots of people have in their portfolios. Market watchers hang on every word. This wait and see isn't just passive, it's a message, and it's watched very, very closely.
They also mention looking back at history, like using low rates during crises.
Right. They often refer back to times like the Great Recession or the early COVID pandemic when they acted aggressively with low rates. And they talk about the neutral rate of interest, sort of a theoretical target rate that doesn't stimulate or restrict the economy as a guidepost.
Okay, interesting. So staying with finance but shifting to personal planning, especially looking towards retirement. Here's a really buzzy question from ABC News on MSN.com. Should you add crypto to your retirement account? Experts weigh in.
Ah, crypto in the 401k. That's definitely a hot topic.
So what are the experts saying? Is it a yes or a no?
Well, like with most things finance, it's not quite that simple. There are potential upsides people point to.
Like what? Big returns?
Yeah, the potential for high returns is a big draw, obviously. Think Bitcoin's historical performance, though past performance is no guarantee, of course. And also diversification, adding an asset that maybe doesn't move perfectly in sync with stocks and bonds.
But there must be a but.
Well, there's a big but.
Yeah.
The experts cited in the article are really clear about the risks, and they are substantial.
Let me guess. Volatility.
Bingo. Extreme volatility is the headline risk. Prices can swing wildly. And then there are questions about liquidity. How easily can you sell it when you need the cash, especially in a downturn?
Right. Not ideal for retirement savings. You need to be stable.
Exactly. Retirement accounts are usually about long-term, steady growth and preservation. Crypto is. Oh, it's often the opposite of steady.
Is the tech making it any easier, though?
The technology, like blockchain, is evolving. And yes, some financial institutions are starting to cautiously dip their toes in, offering options for crypto exposure. But regulatory acceptance is still a huge piece of the puzzle that isn't fully solved.
So the bottom line is caution.
Extreme caution. If you're even considering it, you need to be incredibly strategic, understand the risks fully, and probably only allocate a very, very small portion, if any. It's not for the faint of heart, especially with retirement money.
That leads us pretty neatly into another retirement angle. This one's from AOL. Approaching 55, how should you reallocate your 401k?
Yeah, the 55 mark is often a point where people start thinking differently about their investments.
So what's the big shift? What changes around that age?
The main thing is a change in focus. When you're younger, it's mostly about growth, right? Maximizing returns. As you get closer to potentially needing that money, the balance shifts towards protecting what you have and ensuring income stability.
Less risk, more safety net.
Sort of. You're still aiming for some growth to keep up with inflation, but you're also thinking hard about managing risk. And a huge factor here is what they call longevity risk.
Longevity risk, meaning the risk of living too long. Sounds like a good problem to have.
It is, but financially, it's a real challenge. It's the risk of outliving your savings. With people living longer retirements can easily last 30, maybe even 40 years now. You need that nest egg to stretch much further than it used to.
Wow, 30 or 40 years is a long time to fund.
It really is. So the allocation often changes. You might start moving away from higher risk assets, like maybe dialing back on stocks a bit.
And moving into what? Bonds?
Bonds are a common one, yeah. Also things like annuities, maybe other lower volatility investments that can provide more predictable income streams.
How do people figure out the right mix? It sounds complicated.
It can be. That's where financial planning tools come in. The article mentions things like Monte Carlo simulations.
Monte Carlo? Like the casino?
Sort of, but less gambling, more probability. These simulations run like thousands of different possible scenarios, market returns, inflation rates, how long you might live to estimate the likelihood that your savings plan will actually succeed, that your money will last.
So it helps manage that uncertainty.
Exactly. It gives you a probabilistic picture. And the source also touches on tax implications, like the difference between traditional and Roth 401ks when you start withdrawing. Plus, a really practical point, just postponing retirement, working a few years longer if you can, is one of the most powerful ways to reduce that longevity risk. Gives your savings more time to grow and less time you need to draw on them.
Okay, good advice. Now for something maybe a bit more sobering. From The Motley Fool. Imagine your retirement without Social Security. Would you survive? That headline grabs you.
It certainly does. And while it sounds maybe a little dramatic, it's based on some real projections that we need to be aware of.
What are those projections saying? Is Social Security really going away?
Well, going away is probably too strong. But the article points to the official reports about the OASI Trust Fund. That's the main one for retirement benefits. It's projected to run low, potentially becoming depleted around 2033 based on current trends.
Depleted? What happens then? No more checks?
Not necessarily zero. But if nothing changes, no policy interventions, the system would only be able to pay out what it takes in through ongoing payroll taxes. The projection is that might cover only about 79% of promised benefits. So a significant cut for retirees.
Wow, a 21% cut is huge for people relying on it.
Absolutely. And a big part of the pressure is demographics, like you mentioned earlier. The baby boomer generation is retiring in large numbers, and there are fewer workers per retiree paying into the system compared to past decades.
So the reserves are getting used up faster.
That's the issue. It really underscores why relying only on Social Security for retirement is pretty risky. You absolutely need other sources of income.
Like, well, what are the alternatives?
The usual suspects: personal savings, definitely maximizing things like 401ks and IRAs. Pensions, if you're lucky enough to have one. Annuities can play a role too. The article even touches on some really advanced planning ideas being researched.
Advanced? Like what?
Things using AI, like deep reinforcement learning. The idea is to potentially find more optimal, personalized ways to withdraw money during retirement to make it last longer, adapting to market conditions and spending needs. It's cutting-edge stuff, but it shows people are thinking hard about maximizing resources.
And there's a health angle too, right? Financial stress.
Yes, the source notes that financial stress is a major factor impacting seniors' health and well-being. Worrying about money in retirement isn't just unpleasant, it can have real physical consequences.
Okay, definitely a wake-up call to Sims more if possible. Now let's look overseas for our last piece. This is also from AOL. Denmark raises retirement age to record-breaking high.
Denmark, huh? How high are we talking?
Record-breaking high for Europe, apparently. They're raising the retirement age to 70.
70, wow. For everyone.
For those born after 1970, according to the article.
Okay, 70. That's quite a ways off for many people. What's the reasoning behind such a big jump?
It probably won't surprise you. It's largely the same pressures we just talked about with Social Security, but on a national pension system level.
Yeah.
People are living longer, increasing life expectancy, and that puts a strain on keeping the pension system sustainable with an aging population.
Right. The math becomes challenging. More retirees drawing benefits for more years relative to the working population funding it.
Exactly. But the article raises an important question. Does pushing the retirement age back hit everyone the same way?
Probably not. I imagine it depends heavily on what kind of work you do, right?
That's what the research suggests. The source mentions studies showing that health problems or health shocks often lead to earlier retirement, especially for people in more physically demanding jobs, or maybe those in lower socioeconomic groups who might have poorer health outcomes to begin with.
Yeah, I could see that. Working construction or nursing until you're 70 might be a very different proposition than, say, working an office job until 70. The physical and cognitive demands vary hugely.
Right. So raising the age across the board might disproportionately affect certain groups who simply can't work that long due to health reasons. It creates a challenge for policymakers. How do you support those people?
That's a tricky balancing act. You need fiscal sustainability, but you also need fairness and support for vulnerable populations.
And there's another behavioral wrinkle mentioned. Sometimes people just misunderstand the rules about when they can retire, their eligibility age, and that confusion can impact their actual retirement decisions.
Interesting. So clear communication is key too.
Definitely seems like it. So when you step back and look at all these pieces...
Yeah, you really see the connections, don't you, from making sure the health information we get is reliable.
To how the big economic decisions by the Fed filter down to our investments.
To the really personal long-term planning for retirement, grappling with crypto, or just shifting your 401k.
And then seeing how those same retirement challenges, like longevity and funding, are playing out on a national scale, leading countries like Denmark to make major policy shifts.
It's all interconnected. Personal finance, health, technology, global policy.
Yeah.
It all impacts our future.
It really is a complex picture.
Right.
And trying to navigate all this information, trying to make smart choices for yourself and your family, it's not easy, is it?
No, definitely not. Staying informed is crucial, though.
Well, we hope this deep dive helped make sense of at least a few pieces of that puzzle today. Thanks so much for joining us.
Yeah, thanks for tuning in.
And here's maybe a final thought to chew on. We talked about Denmark raising its retirement age to 70. How might a big call-it-do move like that in one part of the world eventually ripple outwards and influence the conversation or even policy debates right here where you live?
Interesting question. Good thought.
Yeah. Don't forget to like and subscribe Consumers 360 to keep getting these insights curated for you. We'll catch you next time.